All right, in today's explainer, we are going to pull back the curtain on a financial tool that sounds super complex, but is actually crucial for understanding how modern markets work. We're talking about interest rate options.
Think about it this way. The cost of money, what we all call interest rates, it's never static, right? It's always moving. So the big question is, how do you shield your business, or even just your personal investments, from those constant waves? That's what we're going to get into.
To really get that, we have to start with the fundamentals. So first up, let's talk about the incredible power that interest rates hold over, well, everything.
I mean, interest rates are pretty much the heartbeat of the economy. They decide how much you pay for a mortgage, what you earn on your savings, and they even steer how big companies choose to spend their money. They're literally everywhere.
But here's the catch. What happens when those rates stop being predictable and start swinging all over the place? Well, that's when you get risk, a whole lot of it.
So how in the world does the financial system handle that kind of uncertainty? And that brings us right to our next section, where we're going to look at a special set of tools built specifically to tame that risk. We're talking about derivatives.
So what on earth is an interest rate derivative, or an IRD? Well, it's just a contract, but its value is tied directly to what interest rates are doing. The whole point of it is to help people manage, or what the pros call hedge, the risk that comes from those rates going up or down.
Now, IRDs aren't just one thing. It's really a whole family of tools. You've got swaps, forward agreements, futures, but the one we're going to zoom in on today is that last one, interest rate options.
All right, let's put interest rate options right in the spotlight, because we really need to understand what makes them so different and, frankly, so special.
And this right here, this slide, is the absolute core of it all. See, with something like a future, you have an obligation. You have to do something. But with an option, you have the right to do something, but not the obligation. That little bit of flexibility, it changes the entire game. Here's probably the best way to think about it. An option is basically an insurance policy for your money. You pay a little fee up front, that's called the premium, for protection against something bad happening. If things turn out great, hey, all you lost was that small premium. But if things go south, your insurance is there to save you.
So this is the magic, right here. Your downside is capped. You know exactly the most you can possibly lose. It's just that premium you paid. But your potential gain, your upside, it can be huge. That combo, capped loss and unlimited upside, is precisely why so many people love options.
Okay, so where is all of this trading actually happening? Well, this data from 2020 shows that the vast majority, about 3/4 of it, happens over-the-counter, or OTC. That just means it's happening privately between big players like banks, not on a public stock exchange. The other quarter is on those public exchanges.
Now let's zoom in on just that slice that's traded on exchanges. This is where it gets really interesting. Options make up a clear majority, 58% of all the open contracts. So that tells you when people go to a public exchange to manage interest rate risk, options are their #1 tool.
So that makes you wonder, right? If so much of this is done privately, OTC, why bother trading on an exchange at all? Well, let's break down the advantages, because they're pretty big.
Trading on an exchange gives you 3 huge wins. First, transparency. Everybody sees the same prices at the same time. Second, standardization. The contracts are all the same, which makes them super easy to trade. And third, and this one is massive, there's no counterparty risk. You don't have to worry about the other guy not paying up because the exchange's clearinghouse guarantees every single trade.
And speaking of exchanges, right here in India, there's a specific place for this. The National Stock Exchange, the NSE, is currently the only exchange where you can trade these interest rate options that are based on government securities.
Okay, so we know what they are and where they're traded, but who's actually using these things? And what are they trying to do? Let's take a look at the players and what they get out of it.
You know, it's not just one group of people in suits. It's a really diverse mix of market players, from gigantic banks all the way down to individual traders. And they're all using these tools for their own specific reasons.
This table lays it out perfectly. You've got banks and insurance companies using them to protect their huge bond portfolios. Mutual funds use them to tweak their fund sensitivity to rate changes. Corporations might use them to lock in a borrowing rate for a future project. And of course, you've got traders and individuals who are using them to bet on which way they think interest rates are going to go.
And it's super important to remember, for the options we're talking about on the NSE, the thing they're based on, the underlying asset, is an Indian government bond, what's often called a GSEC. So when you piece it all together, what do you really have?
You have these incredibly sophisticated tools that give everyone, from investors to hedgers to big companies, the power to manage the very real threat of changing interest rates with amazing precision.
And that leads us to a final, really important thought. As our financial world just keeps getting faster and more complicated, are tools like these, are they going to become something that we all need to understand? It's definitely something to think about. Thanks for tuning in to this explainer.